please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Special coverage of the macro data that we will be bringing to you. First, the core sector data for July, which was announced today. Latha Venkatesh will be joining us shortly to analyze that, but it's a 6.6% growth, in this quarter.
Absolutely. In the month of July. Yes.
In the
month of June. Well, you're not actually very far from the quarter as well, because June has been revised higher from 6.7 to 7.6%. So it looks like it will be a very good quarter. But this would go, 2 consecutive quarters of very good performance is certainly striking. And the best performers have been cement and steel. Cement growing by 10.8%, steel by 6%, and refinery products by 12%. Actually, coal also has not done well. It did about 12% last month and 9.7% this month. So fairly good performance. All these are year-on-year comparisons. Yeah. Electricity may be a little tepid at 4.8. Yeah. And of course, mining has been a disaster for some time now, and it remains that way. Yeah. But the important point is these are all low bases. So, I mean, Ritu, you did the poll for the second quarter GDP, and you know that the base was 5.6, 5.7. If you looked at the GDP, I think it is 5.6. GVA was 5.6, GDP 5.7. Yeah. So on top of that, even core sector, all that was low. Yeah. That is why you had a low GDP. Yeah. And therefore, all these numbers look good, which is, welcome. Yeah. Especially when you see it in steel and cement. It clearly is a lot of listed stocks, a lot of employment generating, consumption generating items. So that's good, but now we have to wait for the GDP numbers.
Besides, of course, the base effect playing into these macro numbers, it has not just been that. There has been some good news. We saw the IIP numbers fairly impressive. Bank credit growth data has just come out. It's almost doubled from last year. So all around, I'd say there is, to some extent, the base effect does contribute to the optically better looking macro numbers, but there's also good news coming in. The agriculture is also largely expected to support growth this time around. So I think manufacturing, that has seen some acceleration as well. We're awaiting that data. Our poll says that GDP should come in at 7.7%. Last quarter was the fastest growth we've seen in the last 7 quarters. We're still awaiting those numbers, but we're not going to be disappointed, at least if to go by the poll. Nobody's really expecting any disappointment on the GDP numbers, largely, of course, as I said, because of the base effect playing in. Because remember, last year was the pre-GST quarter, which is why you saw some destocking, and it was a fairly disappointing growth number at 5.6%. So compared to that, whatever we get in this quarter will definitely look a lot better.
Shaumya, we have only a minute probably before the big number comes, and you must give me the permission to interrupt you when it comes. Shaumya Ghosh, that is the Chief Group Economic Advisor of State Bank of India. What would you go with, 7.7 or even better?
We are actually at 7.7, but there is a possibility that it could be a little higher than that. And I'll be very surprised if it is lower than 7.5%.
Okay, and would you say that this is largely because of the low base, Shaumya?
To some extent, yes, because around 40 to 50 bips is because of the base effect. So it remains to be seen how far it is above the 7.5 mark.
Okay, Upasana, what are you going with?
Lata, we are going with 7.6% GDP. Marginally lower than probably your consensus. But yes, I would also be surprised with a number lower than 7.5. I would agree with Shaumya on that. And there is a slight upside which is likely, and with the revision in the core index, like you just pointed out, there is a possibility of a slight upside. So anywhere between 7.5 to 7.8 is where I think the GDP number should be out at.
Okay. We also have Indranil Pan of IDFC. Okay, 8.2.
Wow.
Wow.
Okay.
That's a wow number that we have got.
This is the highest in 8 quarters now.
Absolutely. I think it was pre-demonetization that we used to have these numbers of 8.2. I think actually I can tell you when we last had an 8.3 number. I never expected I would be called upon to do that. 8.3 was the first quarter of FY17. was 8.3. And now it is the first quarter of FY19 that we have 8.3. So 8 quarters, I mean, that's a damn good number. Okay, cheers you up. And I don't now mind even saying, even if it is because of a base effect, it is done better than that. A base would have perhaps given it some kind of a fillip, but this is a superb number. Definitely warms the heart. I'm trying to get the PIB website to open, just taking its while. Okay, manufacturing output has come in at 13.5%, but it's, well, the overall economic growth is 8% April, June on a GVA basis. So 8% GVA, and I think GDP is 8.2%. Farm output has come in at 5.3%. So there it is. That's the big number. 8.2 is the GDP number. 8% is the GVA number. And manufacturing has come in at, I think I told you, 13.5%. Okay. We are still awaiting farm. I think I told you the farm number as well. That's coming at 5.3%. I mean, what a wow number.
Yeah, manufacturing, I mean, as of the last quarter, I think was about just a little over 9%. The 13% figure, fairly impressive, and clearly, you know, that has also supported that 8.2%.
No, permit me to read all the numbers because I'm feeling so happy about it. Okay, agriculture 5.3%, mining and quarrying flat 0.1%, manufacturing 13.5%, electricity 7.3%, over a 7.1% last year. So strong growth. Then construction, good, 8.7%. I mean, that's good because it's employment generating. Trade, hotels 6.7%, finance, real estate and professional services 6.5%, public administration 9.9%, overall GVA 8%. Wow number, real wow number. With that, let me go over to our guests. Ashima Goyal, you go first. 8% GVA, 8.2% GDP.
Yeah, this is really good, but we must remember that it was on a low base last quarter, so that exaggerates the rate of growth. But still, this suggests that you know, the turnaround is there, and that there's an intrinsic resilience in the economy, because despite zero macroeconomic stimulus and external stresses, we are doing well. So this is something sustainable. It's coming from, I think, capacity erosion, so that firms are beginning to invest. Some turnaround in exports. I think there was a survey I saw recently that firms are no longer complaining about GST. Okay. So maybe exports are picking up because of that. Okay. I would like to see the export growth number. Is it there?
It is. Just give me a minute. I should be able to calculate the numbers and give it to you. But I think private final consumption expenditure has come in at 8.8%. Very good private final consumption expenditure. Government final consumption expenditure has come in at 11.8%. Exports, well, I'll calculate the increase and tell you, Ashima, in just a minute. But private final consumption expenditure doing so well. Your thoughts?
Yeah, I think we keep talking about agricultural distress, but when you talk to fast-moving consumer goods companies, they say that they're selling more in rural areas also. There's a pay commission in urban areas. So, and possibly some, I think the REJA has settled down, even housing. So all this is contributing to a rise in consumption.
Okay, now I've got gross fixed capital formation. That's rising at 9.5%. Now, all I have to tell you is exports. Just give me a minute. I'll tell you the percentage increase. 1 minute. That's come in at, okay, not bad, 12.6%. Exports coming in at 12.6. That's very good. Not bad at all. Not bad at all.
Yeah, you know, I was thinking because about 2-3 quarters back, you saw manufacturing turn up. And at that time, I said that possibly down the road, we'll see exports increase. And slowly they have been, because possibly there were supply constraints. We missed that rise as global demand was rising. And then I found that when oil prices are sort of middling, not too high, but not too low, our exports tend to do better. We have demand from the Middle East and so on.
Yes, that is our destination countries did well. We should do well. 12.6%. Exports gross fixed capital formation 9%. Government final consumption 7.5%. And private final consumption expenditure 8.8%. I think, gentlemen and ladies, you have all the numbers now in front of you. Shoumya.
I think it's a pretty good set of numbers, but agricultural, I am surprised with the number, because if you look into the Rabi output growth, that indicated a 3% growth. Possibly the buoyancy in agriculture is because of the allied activities. We need to see whether it's because of the allied activities or the agricultural food grain production. But the important point is that if you calculate the core GVA, which is basically the private sector one, that has actually surged to 8.1% as against 7.2% last time. So it's a number which is primarily driven by manufacturing, because the corporate earnings were very strong. So the manufacturing GVA actually has been very strong, and that is in excess of 13%. Service sector, if you look into the numbers, they are actually in the 6 and most of them are in the 7%. I think, apart from the public administration segment. So that indicates a little bit of maybe a growth rate close to services 8%, but overall a very good set of numbers, and it indicates that the growth rate this time, even if you exclude the base effect, is actually over the trend growth rate of around 7.5 to 7.6%. So that's the bottom line of the GDP
We are above
data.
the trend growth rate, so you will perhaps want to revise your full year numbers. I'll come to that in just a minute. Indranil Pan, your thoughts? Would you want me to read out all the numbers again? They are, of course, flashing for you on the screen as well. Very quickly, for those of you who just joined in, the agricultural growth has come in at 5.3%. and I think
5.3%. Mining is 0.1%. Manufacturing 13.5%. Electricity, gas, water supply 7.3%. Construction 8.7%. Trade, hotels, other communication and services 6.7%. Financial, real estate, professional services 6.5%. And public administration, defense and other services at 9.9%.
Yeah, and that is from the output side.
Yeah.
And from the expenditure side, you have private final consumption expenditure 8.8%, government final consumption expenditure 7.5%, gross fixed capital formation 9.5%, and exports 12.6%. And I'll tell you, we've got the full year numbers of last year just to compare. Now, gross fixed capital formation grew at 7.6% for full year. Now, in the first quarter itself, we are doing 9.5%. That's 200 basis points higher.
Yeah.
Exports last time around, okay, I don't have the exports year-on-year number. Yeah, it's 5.6%. And now, first quarter is 12.6%.
Yeah.
Any which way you slice it, it's good, except government final consumption expenditure. Last year was 10.9%, this time is 7.5%, which is good. I mean, we're doing less with the government crutch. And there is capital formation and private consumption, which is picking up the slack. For me, it looks good any which way I slice it. But go to the expert, D K Joshi, what did you make of the numbers?
Well, I think it's better than I expected, and I think we now firmly retain our forecast of 7.5% for the full year. I think the only concern is on the services side. The private services, particularly finance, real estate, and trade, hotels, I think those segments are still weak, and I think they're growing below their trend. I think you mentioned the growth was between 6.5 to 6.7% for both. So I think that's because of I think the banking sector stress. I think the lower profitability is getting reflected in GDP numbers, and the telecom is anyway in pain. So telecom is also pulling the services down. So I think that's the only concern. But otherwise, I think from an employment perspective, I think this is a healthy growth because both manufacturing and construction are quite strong.
Yeah.
So I think it's in a way, I think the growth is coming from employment-intensive sectors, including agriculture.
Well, I'm sorry. I think I was starting the conversation with Indranil and it went on to Mr. Joshi. Indranil, your first thoughts and anything we are missing out in what looks like a perfect set of numbers?
No, I think DK as well as Shoumya has sort of broadly talked about the current numbers, which definitely are on the positive side. Our own estimates were 7.8%. But I think crucially looking forward, we need to also sort of start analyzing what is the type of sustainability to the 8% plus numbers that we just saw for the first quarter. And I think there could be some ramifications over there in terms of the interest rate cycle turning, in terms of the overall inflation expectations being on the higher side, which necessarily means that to a certain extent you might not see a significant sustenance of the personal consumption expenditures. Now, the personal consumption expenditure being on the higher side could also have been a fallout of the huge amount of farm loan waivers which artificially pushed up consumption in the rural segment. Shaumo clearly indicated that the Rabi was not as healthy as the agricultural sector growth numbers have showed up with. The second issue is with the manufacturing sector, which definitely has a base effect, but going forward I think oil and the overall increase in the financing cost can actually pull down those numbers to a certain extent. So I think it's again the whole argument is as we were discussing even sort of some time back, it's likely to be two halves. The first half is likely to be quite good in terms of the GDP numbers. Yes, this number has surprised on the higher side, but the second half numbers could be much lower than the first half numbers, and that should actually be able to sort of bring down the overall GDP growth for the year to about a 7.3 or a 7.4%.
Okay. No, I take your point. In fact, I will be asking all of you your full year numbers and whether you all are going to revise it. Soumya, to you that question first. And in fact, I left you with that question. Are you now going to revise your full year estimates? Where do they stand now? Reserve Bank stands at 7.4. Do you think that RBI also will up it? And what are your current and likely revisions?
No, we were actually at GV at 7.3 and GDP at 7.4. So I think we had built in a growth rate in excess, if close to 8% this for the first quarter for this number. But given the fact that the growth rate is now in excess of 8%, we may have to look into the numbers, but we need to watch out for the other quarter trends, because I think the second quarter will be good, but the third and fourth quarter numbers will again, this time they will suffer because of an adverse base effect. Yes. We are now for a better base effect. So I think these numbers will be crucial. And in my sense, I think it could be average out to around 7.5% at the end of the day.
Okay, so that's where I think Indranen also stood.
And that is the CSO's estimate as well, 7.5%, 7.4 RBI. I think Upasana...
RBI stood at 7.4.
7.4 yes. And CSO at 7.5%. Upasana, what is your full year number?
Yeah, we were earlier at 7.3. We, of course, will have to relook at the numbers given the first quarter is significantly higher. But having said that, like the other panelists have said, I would tend to agree that the second half of the year is definitely going to be much slower. And already some of the lead indicators are suggesting a little bit of slack going forward, which along with the adversities in the global scenario clearly may be weighing on the overall growth scenario. So we may still have to be watchful of the upcoming data prints before we can really take a final call. But yes, there is a chance that from a 7.3, we may be somewhere between 7.3 to 7.5% for the full year.
Do you also look at the how do you look at the 5.3% growth in agriculture, Upasana? Do you think you know what we saw of the Rabi crop you know output? Does this number not match with what you had expected? Do you think it's a lot to do with the allied and fisheries?
Yes, clearly. I mean, we were at a significantly lower number than what the actual outcome is. And that's where we are surprised. But we need to see the breakups within the agriculture to see whether the allied services have really probably outperformed the Rabi output, because definitely a Rabi output was not suggesting such a strong you know, output in agriculture sector. So I guess it will be the food output which would be which would have contributed this kind of a fill up to growth. Okay. But we'll have to look into that to really get further clarity.
Okay, well, let me ask. I mean, most of you are bankers actually, so I didn't even pick and choose. Soumya, bank credit has grown at 12.9% for the 2-week data that RBI puts out in the WSS in the weekly supplement. 12.9. We have something good going here.
Yes, before that, Lata, I think, yes, the point which all of us are making in terms of the agricultural segment, that exactly is borne out by the numbers. The 45% non-agri, the forestry and fishing segment has grown at 8.1%. So that actually explains the jump in the 5.3% of the agricultural growth rate. So that was some sort of a reason for this 5%
non-agriculture rural growth.
Regarding the bank credit, I think.
You mean non-agriculture?
Yes,
okay,
the livestock, forestry, fisheries.
Sure.
Exactly. So
it
that
has grown
allied activities has grown at 8.1%.
Wow. Okay. Go ahead. You were telling
8.1.
us. Yeah, got it. You were telling us about.
So that's one of the reasons. Yeah, but regarding the bank credit, I think Lata, last year the first 3 to 4 months were quite bad in terms of the credit growth. But this year the credit growth numbers have continued to be in the double digits even in the month of July and August. So I think there is definitely an uptick in the credit growth cycle. And what we are seeing, if you just break out the data in terms of the project numbers, the number of investment proposals which is coming up is showing actually an amount of an uptick, but they are mostly small ticket size. So yes, there is an element of growth in the system, but my concern is that given the current uncertainties in the market, it remains to be seen how far this credit growth sustains in the remainder part of the year. My sense is that the year should end in the credit growth of around 10 to 12%, may not be more than that given the current situation.
Okay. All right. Mr. Joshi, you know, we have to come to terms with several indicators that are looking better than we thought. Look at the core sector. 6.6 this month, that is July, and 7.6 revised from an earlier 6.7. 7.6% core sector growth for last month, that is June. Again, GDP numbers, our poll had thrown up only 7.7, and we land up with 8.2 in terms of GDP. GVA is 8%. Likewise, credit growth now 12.9%. We are firing on several cylinders, Mr. Joshi. Is there a good chance that this is only partly base effect, but the momentum is actually picked up to probably, you know, the 2014-15 period?
No, I think there is definitely a base effect, but I agree that there is a pickup in momentum, and I think it's visible. I mean, when you look at the capacity utilization across sectors, particularly sectors related to construction like steel and cement, I think that is now approaching levels where I think the companies could be looking at expanding capacity at some point in time. And automobile has clearly reached that threshold, and I think automobile, we should expect private investment this year itself. So I think things are moving. I mean, at the ground level, I think a lot of indicators are showing buoyancy. I think there is base effect, but I think it's much more than the base effect.
Shaumya, if you could also answer that question, you know, if we subtract the base effect, how much do you think is the real growth that we're looking at? What would the figure look like if we had a similar figure the last year around as well?
You had, I mean, this 8.2% net of the base effect.
Yes.
That you are asking.
Yes. Without the base effect, what would the number look like?
Yes, basically I told at the... Yes, the base effect is around 50 basis points, so the number should be actually 7.7%. So from that point of view, this growth is definitely over the trend growth rate which the market was estimating.
Okay. Would you, Indranil Pan, you sounded a little more skeptical than the rest, but going by these various indicators, you know, GDP coming in at 8.2, GDP coming in at 8.2, that is 8% GVA. Core sector doing reasonably well, obviously a subsect of this. Credit growth at 12.9%, rupee having depreciated now to 71, and crude at 77. What does all this mean for MPC policy?
No, I think I have been sort of one who have been relatively sort of hawkish in terms of the policy status of the MPC, and I was clearly on an October rate hike, and the crucial point out there was that the RBI would possibly have to look at even the currency dynamics to decide and sort of take the cycle forward. So I think we stick to that point. The probability has definitely gone up after the currency is very clearly settled above the 70 at this point in time. And with the global volatility having picked up very significantly, including the fact that IDR also depreciated, and that puts pressure on the Indonesian central bank to also hike rates. So we can't be possibly seen falling too much behind the curve compared to the other relative peers, and Indonesia possibly is one of the closest sort of peer in terms of the macro dynamics and also in terms of the political cycle that they follow. So all taken together, I would continue to expect the RBI to move at 25 basis points in October, not to wait till December as a significant portion of the market had continued to point out. Beyond October, if you really ask me, honestly, I really don't know.
Okay, well, Upasana, 3 back-to-back rate hikes warranted by the array of good numbers.
Well, Lata, earlier I was of the opinion that probably a rate hike purely, based on the growth and the inflation dynamics, I would have still continued to believe that there was no really need for a rate hike right away, a back-to-back third rate hike. However, in the last 10 days or so, the pace at which rupee has been depreciating, that continues to, increase the probability of a rate hike as early as October. And yes, if this pace of depreciation continues into the next few days, then clearly we'll have to brace ourselves for early action than later. I would agree with Indranil that we should not be left behind when all the other emerging central banks would be, waiting to act as soon as possible to curb their depreciation. So I think at some point we will have to take a call, and if we continue to see this pressure on currency, then a 25 basis of a rate hike in October policy is definitely likely.
Okay. See, now that's 3 back-to-back rate hikes that people are talking about. Obviously, that would be a fillip to the rupee as well, or at least stop it from perhaps reaching some kind of a panic selling. This is, I think, fairly civilized depreciation of the currency, fairly gradual, and maybe, just waving that rate hike flag might actually slow down the depreciation. Soumya, would you agree? Third back-to-back rate hike?
See, there is a conundrum over here because the food prices have actually significantly declined. So we are looking at an inflation number which is possibly lower than 4% this month. But having said that, as I have been saying, there has been a shift in the RBI exchanges tactics in the last couple of days, because it has shifted from being a little bit hands-off of the market in terms of the intervention strategy. So if that is the strategy going forward, and that is the thinking in the central bank, that realization leads to higher amount of cost, then it could actually look into other options in terms of stemming the rupee depreciation if the trend continues. So I will not completely rule out a possibility of some rate action if the current trend of rupee depreciation continues, given that the thinking in the RBI in terms of an intervention now looks less likely than it was earlier.
Okay. Well, a final question then. Well, who shall I toss it to? D K Joshi. There was a conversation going on that probably India's potential output growth is 7.1%. I'm confusing things over here. I'm saying output and I'm saying growth. But the potential had probably come down to 7.1. Is that thesis now good to be challenged?
Well, I think the investments have to rise for a sustained period for the potential to go up. I think potential also will have an upside from the reforms that I think particularly GST will work towards enhancing productivity. So I think there will be so investments as well as the efficiency enhancing reforms. I think these imply that the potential will go up slightly. But I think potential itself is a fuzzy concept. I mean, putting a number to it is extremely difficult. But I can definitely say from the directionally, potential will move up.
Okay. Well, gentlemen and ladies, we will leave it at that. Thank you very much for joining us in what has been an extremely exhilarating analysis of the GDP numbers. Well, it's such a long time since we have seen 8 and 8.2. Oh. I'm very happy. I mean, this is growth. This is the kind of numbers we used to reach some time back, and it's good to have it back. We wrap up this edition of the macroeconomic analysis of the data that has come in from the Central Statistical Organization. Do stay on with us. More news and updates follow.